Hi, I'm Ron Rowland, editor of the International ETF Trader. The big news in the markets lately has been the surge in oil prices. And when many experts talk about that rally, they refer to oil futures. If you're considering investing in commodity ETFs, it pays to understand the futures market, and especially one particular challenge that ETF sponsors often face when buying commodity futures, called contango. First, we need to distinguish between futures and securities. When you buy a security, often a common stock in a company, you immediately become a partial owner of all that company's assets. With futures, you aren't buying or selling anything. Instead, you are agreeing to buy or sell something at a later date. This is why you hear about spot price and futures price. Spot price is what you pay to get delivery right now. The futures price involves transactions that will happen later. I'll give you an example. Suppose you own an oil refinery. You buy crude oil and then convert it into usable products like gasoline or jet fuel. And you know that in August, you'll need 500,000 barrels of crude oil. Meanwhile, someone else out there owns an oil well that will be producing 500,000 barrels of oil a month this summer. Neither of you knows what the price of crude oil will be in August. It may be higher than today's spot price, which is good for the producer, or it could be lower, which would be good for you as the consumer. Since you both have businesses to run, you need to eliminate this uncertainty. See the basis for the deal? The two of you agree that in August, you will buy 500,000 barrels of oil, and the producer will sell it to you at a price that you both believe is fair today. That is a futures contract. The futures markets exist to standardize and facilitate this negotiation process for oil, metals, agricultural products, and many other goods. When a market is in contango, it means that prices for a specific commodity are higher as you go out further into the future. This is the normal state for most markets, and in fact, you can see it with the crude oil contracts today. The front month, or the April contract, for light sweet crude is trading between $101, $102 per barrel today. But the prices get steadily higher for contracts later in the year. This is a problem for ETFs because they never take delivery of the commodities they're investing in. Instead, they periodically sell the contracts that are close to the delivery date and replace them with other contracts that are further out in the future. So when a market is in contango, the ETF has to sell contracts at a lower price and then use the proceeds to buy other contracts at a higher price. As a result, the ETF now owns fewer units of the commodity than before. The differences may seem small, but over time, they can really add up. With some types of ETFs, you can solve this problem by taking delivery and storing the commodities, like the sponsors of the physically backed precious metals ETFs do. All you need to store gold is a bank vault. But with oil, you need huge tanks, and you need a lot of them. Grains and agricultural products have the additional issue of being perishable and can't be stored indefinitely. So if you own any ETFs that use futures contracts to track commodity prices, you need to be aware of contango. Three funds that are particularly vulnerable to contango are the United States Natural Gas Fund, the United States Oil Fund, and the iPath S&P GSCI Crude Oil Total Return ETN. Investments like these are best used as short-term trading tools before the negative impact of contango can add up. I'm Ron Rowland for Money and Markets TV. Thank you for watching.